Awesome. Thank you everybody for joining us again. We do once a month legacy webinar, and we talk about good investments, bad investments. We talk about us. We talk about our guest. We talk about commercial real estate. We talk about investing into real estate. We talk about our experiences, and and one thing we know that none of us know it all, right? So that's why we invite our friends and experts. Today, I've got a really interesting personality. David is a close friend, impressive success journey. He started as and he can go into his own background, but David Priest and his lovely wife Stacy Bella, two great people. I'm really honored and blessed to meet to know both of you guys. I'm really thankful, David, for your time to come on our monthly webinar. Why don't you tell everybody about yourself, who you are, what was your background, how does wealth generation and real estate happen to you, and what were you doing before, what you're doing now?
Right. Well, I've been in real estate for about 20 years total, but I spent most of that, like the first, I would say 17 years in what I call transactional real estate, which I was a real estate broker and a mortgage company. I was doing, one deal at a time and kind of being transactional. And then I started getting into commercial. I really got interested in it in 2023 and I started going full time, but I had some ups and downs getting into the business like a lot of people do. And till I kind of found what my place was and what I did well.
Awesome. Tell us a little bit more about what you're doing now, and how is that different from what you were doing as a W-2 or self-employed?
Yeah. Well, I was self-employed since 2008. So I was real comfortable being a self-employed person. My wife was working in oil and gas on a W-2. And so we had the stability, which allowed me to go out and form businesses and have the ups and downs of having a business. And so I was very entrepreneurial to start with. I think the biggest mistake I made in commercial in the beginning, as you are aware, is I came from a solopreneur kind of do it all. I'm a smart guy. I can do everything. I can figure it out. Background where I did everything myself in my businesses with very little help from other people. So when I got into commercial, I thought, well, I can go and I can kind of do this on my own and I don't really need to like a lot of help. And I'll just read and watch a lot of podcasts and get really smart and I'll figure it out myself. And I found that, commercial, especially apartments, is kind of a leviathan if you're trying to do everything yourself in the beginning and it will eat your lunch. And it kind of ate mine up in the beginning. That taking action and really wanting to make it work is what it led to eventual success, but it wasn't easy in the
Yeah.
beginning.
So now you are into investing more, and we'll go into a little bit more into that. But one thing I want to summarize what just David said is he was into a W-2. He started his own business. He was a mortgage broker. So starting from a W-2 to come into your own business, call it 1099, and you kind of followed that quadrant that Rich Dad and Poor Dad talks about. And now you're into passive investing. I want to make sure that I'm saying this very clearly. What I know about David is that he's don't go over his looks. He looks like a very soft-kinded person. He's extremely hardworking. I can tell you that. I've seen him going into all kinds of events and all kinds of um, activity that's required to be done by an active investor. And we're going to go into a little bit more of that. What is an active investor and passive investor? But long story short, um, if you are somebody who are a W-2 employee, started as a solopreneur or 1099 or self-employed person, now you're wondering, what should I do as the next step? You know, I'm making this much, but I'm almost paying half of it in taxes. And what does that mean? So, David, tell us a little bit more about our interaction. How did we met? It's an interesting story. I want people to know, and I know you gone through, and I don't want to share. I know it's a privacy situation, but you gone through a very difficult, tough time medically, right? And you came out as a fighter, right? And now you're totally doing so much great that I think a lot of people should know about it. But specifically, tell us how we met, and I know you hated me in the first. It was
No,
okay. Share the detail with our audience how we met and what was our journey.
so the interesting thing is during the time I was very, I would say, transactional in real estate. I was doing mortgages, I was making money. I never bought any single family rentals because it's interesting because I didn't want to manage rentals. I didn't want to do repairs. I didn't want to collect rent. I didn't want to do any of those things. And, three things really happened between 2020 and 2022, which were, first of all, we had COVID. So I had all the money in the stock market, got cut in half for about 3 months. I didn't sell, but it gave me the shakes like, wow, I got to get in some real estate. And then I did get cancer in 2022. I was diagnosed in January. And so I had to take some time off, do some chemo, had leukemia. I'm healthy now, but it was very life changing for me that I felt like I wasn't living my purpose, my highest self. I was kind of mediocre in my life, and it really was a wake up call. Like I got to go out and do something really interesting because what if I'd gotten sick and not made it? I was kind of questioning my life, and it made me change quite a bit. And then the inflation happened in 2022. So I saw things zooming out of control. And I saw my own personal private residence go up about 50%, like in 2 years. And I was like, wow, this
Yeah.
is amazing. Real estate's great. I got to find a way to participate. But I knew I didn't want to go buy rentals. I didn't want to do any of the operating. So originally, I started learning about syndications and being a passive investor. And that really appealed to me and it still does. I've got deals I'm a passive investor on that I don't participate actively at all. And I think if you're an active investor, you should do both. I think you really should do both because if you're only doing your own deals and you could be a great active investor, but if something really goes wrong and you really buy the farm, you could lose everything. So having money in other places is smart and not keeping it all in your own deals. But when the inflation took off, it kind of choked off my mortgage business. It's very rate sensitive. My wife had left her W 2 to spend more time with our children and be a stay at home mom and help
Mhm.
me out in my business. So all these things came into. So the funny part of me not wanting to do any single families is I started going to conferences to get educated and I got like, wow, this is cool. These conferences are like a herd of unicorns. They're just like me. So
Yeah.
I decided I really wanted to go do it as an active person. So I defaulted back to my solopreneur type of work ethic. And it's interesting because I went from not wanting any rentals to wanting to go in and buy an apartment building and kind of do it all by myself. So we got a fairly big deal for our first deal. It was a
What
90.
year was that, David? Tell our audience what year where you decided to buy your own deal and walk us through a little bit more in detail
Yeah.
from
This
timeline.
this was 2023, and I went to a conference early in that year, I think in February, one that's here in Houston, and I came back from that going, "This is like what I'm gonna do for the rest of my life. I love these people, I love this business, there's people making money, they're having fun." It was still kind of a gold rush time in the business. Things were just starting to turn. And I was hearing that, hey, wow, apartments, it's really gone down and it's kind of crashing and it's a big mess right now. And so I thought back to 2008 when me and my wife got married and the stock market crashed. I went all in on that and I made a lot of money. So when people say something's crashed and I don't own anything, I'm like, it's a good time to be a buyer. So I started looking at deals, studying due diligence, learning underwriting, which is really good. It's a good background. So I thought I was going to do it all myself. So I was trying to learn everything. I got a deal under contract, I think in October of 23. It was October, November, right in that time frame. And I had a very small team. It was going to be me and another person. I had a key principal because the loan was bigger than what I could sign on with my level of experience. And he was going to help me raise the money. We were going to do like a two-man syndication, like a really small team. And I wouldn't recommend that to anyone now. I wouldn't invest that kind of deal. But at the time, it was like, oh, okay, this is good. I'll keep a small team. I'll use what I need. I got in the deal, got under contract. We had a lot of problems. The main problem we had was right at the end of the due diligence period, the lender told me my key principal signing on the loan was in trouble with Fannie Mae and he could not sign on a loan and he couldn't be a partner on the deal. And I didn't have a backup plan at all. So all of a sudden, I'm down to me, and I was not going to be able to get it done by myself. And we had money going hard, and things were getting very expensive. Due diligence, legal, it all starts adding up. The bills come in fast. So
Would you share with our audience how much was your personal money on the line, and what was the timeline look like for you to make a decision or make a move to save that money?
I had 30 days on the due diligence and I could have walked. I had 30,000 that went hard originally. But at the end of that, when we had these problems, I mean, I remember being in San Antonio, my wife on vacation after Christmas, and it was like, hey, we got like 2 days. We can walk on this or we can keep going. And my wife is like, hey, let's figure this out. Let's solve problems. Let's go. She was like, let's go. And that's great. So I mean, I was kind of that way too. But if she had told me, maybe we should back off this, I might have. But she was very encouraging and extremely supportive. We decided to go along with it. and we thought we had the problem solved, possibly because we got another key principal, but then the lender came back and said, "Well, he's in Florida and you're a rookie. We want someone on the ground." So I called the broker kind of in a panic, like, "Hey, we're things are getting really bad over here. I need someone that I know 100% can close a deal in Houston. They need to have a portfolio. They need a track record. I've got to get that." So he recommended you, and I called you, and we talked, and you
You as in who? Remember that we have to record that. Who recommended who?
it was the broker that recommended you. I didn't
And
know
who
who
is you?
Oh, you Sid. I recommended you the
Remember, we have
first.
to record this, right?
Okay, okay. Oh, he recommended I call you, and we talked, and you were willing to help. Most likely to keep a really good relationship with a broker. It was a side project for you, I know. You already had a big portfolio, but you're willing to help, and we did, you know, I didn't say we, like, hit it off in the beginning, but I respected you. I mean, I was a drowning man, and you were throwing me a life ring, and I was like, "Hey, I don't care if there's a life ring, I gotta make this work." But one thing you made me do that was really good is we re-underwrote the whole deal according to your standards. I went back and I was secret shopping apartment complex. I went back and kind of redid a lot of things and a lot of homework. And then I started seeing the deal was not quite as good as I had thought it was. It wasn't really the standard that you would close on a deal, but it probably would have been workable. It probably would have been okay. So some time went along, and then eventually I felt like the deal was kind of deteriorating. We were finding more things that were maybe not as good. We were taking another look at it. And one day I just woke up and decided, I think I need to walk on this deal. And I went and talked to my wife. I said, "We're going to lose some money here, but I think this is the right thing to do because if we're having this many problems before closing, I don't think I'm ready to really operate an apartment complex. I think I need to." And my reputation I felt was like on the line. And so I was like, if I go in and I do this and I do poorly, and I had a lot of commitments on the capital raising already. I mean, I was like doing webinars and I knew I could do that. That was the only thing that was going right. It was like I could raise money. I could talk to people. I knew how to work with the investors.
Three problems that you identified, roughly speaking, what did you remember that, hey, because of XYZ or one, two, three, top three problems, I don't want to touch this deal. This, I mean, irrespective of what Sid is saying, but it just, what was my feedback and what was your thinking process and how it came together?
Right. Well, I think, I mean, you looked at the deal in a way that was very, I mean, you kind of tore it apart a little bit, which is good. I mean, we went and we kind of tore it apart again. You thought my assumptions were way too positive on how quickly I could raise rents. And you were correct about that. I didn't know at the time. I thought, well, these rents are 10% below market and we can jump these up. Well, you can't do that in 12 months. It's just not possible. And I know that now, but back then I was like, hey, they're 10% below rent. Let's just, raise him 10%. But what would have happened if we had done that most likely is the occupancy would have gone from 92 to 72. And I would have lost a lot of people. You would have a lot of turns. And, there's nothing worse than a zero on the rent
Yeah.
that month on the rent
When
roll.
you walked away from that deal, can you share with our audience? And if you don't want to, that's perfectly okay. Because I want to make a point here. How much money did you lose personally, and you and your wife, Stacy?
Okay, it was about $180,000. It could have been close to two. I was a little bit under 200, but also it was my personal money. I didn't lose a dime of
Yeah.
investor money.
So I
People
want to
think
point this out, David. I want to make sure people are listening to this. The integrity is a part where you take the hit in order to do whatever you can to save investors' capital. Um, when David came to me, a deal came to me for a review. I immediately thought this is way too much. This person is paying way too much. He's in a tricky position because he's already hard almost $200,000 saving. And my feedback was like, hey, look, I'm going to do everything to help you, but I really think this is not a deal for you. There's several reasons, and I can speak all day long for that. But what happened after that, David, which you may not know, the broker was not happy, right? He called me like, what the hell, dude? I sent you a referral, and look, brokers doing their job. They're trying to sell the deal, and that's absolutely what they should be doing. But I told him, hey, I'll make it up to you. I'm gonna have money on my property that I will sell it through you, and whatever the money that you're not able to make with that transaction, you will make it that way. That was perfectly fine. But the fact that you walked away from that much money, seeing it through, that this is a difficult commercial real estate transaction that you won't be able to sustain, that speaks volume to me, right? And that's where I really start, not only liking you but also respecting you. It's like, hey, this gentleman is, and I remember we had a detailed talk on a coffee, but Am I summarizing it right, David? Or do you
Yeah,
want to
yeah,
summarize
and
them?
in fairness to you and the broker, you never told me you need to walk on this deal. What you told me was, "I don't think you're going to make as much money on this deal as you think you are, and here's why." And that was a factor in it, but a lot of it was things were going wrong, the financials were deteriorating, the oxygen was deteriorating, the deal was kinda going the wrong way, and I felt like, "Okay, this is maybe not what." You gotta remember, I was getting commitments from investors on my pro forma that I had done, that I created, thought that was good, and then we created one that wasn't as good, so people had committed to something that was really not as good as what it was probably going to be, and yours was obviously gonna be more accurate. And I remember going to my wife and saying, "Look, we're gonna lose money," and she said, "How much?" And I kinda tallied it up, and she was just like she was not happy, obviously. But I said, "This is like a black hole that's gonna get worse," because we were coming up on having to put more money to extend, and it was just gonna go on for at least 60 more days probably.
Yeah.
And I told my wife, I said, "If we walk on this deal right now and I go work with someone on another deal and I can raise X number of dollars and I think I can do this, I'm gonna make the money right back over the next few years and we're back to even, and then we can just kinda go from there." And so that was my whole thing with that was my wife. I said, "We're gonna
Yeah.
lose money anyway, but this could get worse. This could go out for 2 or 3 months
Yeah.
with more money and, another 30 or $50,000. We still don't close. We lose even more money." But a lot of it was about wasting time
Yeah.
and wasting days, and that was where my mindset from when I had cancer. Boy, the worst thing in my life right now is to waste a day. I don't wanna waste
Yeah.
any days. So it changed my thinking. I was like, "This is the time," but I said, "We can waste time in this. We might close it, but if we go and do something else, I can go raise money on something else. I'll make the money right back. We're back to even, and then we grow it from there." And
Yeah.
we
Yeah.
made a mistake. However, if I had never put the deal under contract, taken action, gone out there and been a little bold,
Yep.
I wouldn't have met you. I mean, I could have
Yep.
still been sitting in my office now underwriting deals and calling brokers and never
Yeah.
done anything. Nothing would
Yeah.
have happened at that
I
point.
always
So it
say, I
paid off.
always almost nothing comes really good out of your desktop in your office. You got to go out, meet people, take action, which you did. You show the integrity of walking away and lost your own capital. And I tell my employees and my partners who are active partner or people, you got to change your relationship with money, right? Rule number one, never lose money. And rule number two is to follow rule number one. And I'm a full believer in that. But if you are trying to be an active business owner, there will be a situation, and I'm pretty sure there are audience in this webinar. There will be a point where you will have to cut the rope. You have to pull the plug, and at that point, you got to know what is your relationship with money, right? Are you willing to risk other people's money to save yours, or are you going to move away or walk away at the time where you take the pain and other people save it? The other thing I'll say, I've I think I've talked to at least multiple people about um, getting into this business of commercial real estate ownership. In one day, I sat down with somebody and I wrote it down, all the actions, all the areas that you have to work on. And we came up with 33 or 34, some really big areas to work on. And just to summarize, you not only have to build a relationship with the brokers, you have to find the deal, then you have to underwrite it and finance it, and then you have to raise capital. Then you have to find a management company or you hire a manager. Then you have to manage it and you have to do all of the renovation. You have to raise rents. You have to do the customer service. Then you have to work on your renewals. You have to do all of that. And then you have to bring the legality in the terminology. You have to hire the legal team. You have to make sure that your legal paperwork is in line. And when you add all of this, it's 33 plus items that you have to work on. And I tell people all the time, every single time, it's almost impossible for one person to do it. Now the question is, how did I do it? Well, I jumped into it without knowing it, and all I did is I did not quit. Right? Was it easy? Absolutely not. Did I lose money in some ways? Yes, I did, but it came out okay. Just like for you, right? Tell our audience a little bit more about what you're doing now. First, I want to ask you what is, in your opinion, the difference between an active investor or a passive investor? How these two are different? Why one should go one route versus the other? And how you navigated that translation in your career so far?
Right. Also, too, one more thing on losing money. I think it was really helpful in my career and what I do now
Yeah,
because I know the pain that
yeah,
it causes and how much it is horrible. So it makes me a lot more careful because if I'm an active investor, I'm going to invest money in my own deals. From a passive, I'm looking at things a lot harder. I'm trying to protect the people coming in with me a lot harder. It was an essential element to what I'm doing now. Like you said, the Warren Buffett never lose money, and then look at rule number one. But I have rule number three, which is never lose other people's money. I want to try to have a perfect track record. That's my
Yeah.
standard. I think with being an active investor, it's a mission and it doesn't buy time freedom. So if you're one of these people that wants to retire and you want to have time freedom, and let's say you want to go to Europe for the summer for 3 months and not have to worry about checking in, then active investing is probably not for you. You don't get that. Passive investing allows you the time freedom. It allows you doing all the work. You were talking about just getting a deal to contract. Now, I see deals now when I raise capital where they've already worked with a broker, they've underwritten 100 deals, they've chosen a deal, they've done due diligence. There's like blood, sweat, and tears just to get it to me. And then I get it in the sweet spot where it's like between getting a sales contract and a closing. And that's the area I work in. That's like the easiest part of the whole thing, finding the deal and sourcing it and doing all those things. The raising part of it to me is one of the easiest things. It's what I enjoy. But then on the operations, that's when all the difficult things happen. So if you want to be an active investor, it's kind of a calling and I love it. But if you're a person out there that wants true freedom and time freedom and be able to, travel and do things and not worry about all these things and not be bothered with all the emergencies, then it's not the right thing to do. And like I said before, I tell people if you're an active investor, if you go out and you're hitting home runs, you should take some of that money and put it in passive deals. So your money is working when you're not, because there's only so much you can do. So having that on the side, I think is a really good idea.
Awesome. Being an active versus passive, say if somebody's a physician, own their own practice, they own their own building, I always tell them if there is an opportunity for you to invest in your own business, do that, right? But at the same time, know what will be your tax liability. Once you have the surplus, you really want to see what you can do as an investing passively in other deals. And that's where you get your own tax benefits and your own preservation of capital. But once you become an active investor, meaning now you're really signing up for a new job, right? And that job
Right.
is, I can tell you that it's not 40 hours. It's at least 60, 70 hours a week. And so that's the big difference, right? Now, David, you're doing something interesting, which is very common these days. You are a passive investor, but your returns are way higher than a regular passive investor. Obviously, you and I know that how it works. I want you to simplify it for our audience. How that work? How are you doing it that maybe somebody else wants to do that again? Look, we both know this creates competition, but our mentality is abundance mentality, right? Go ahead,
Yeah.
create competition. But here's one thing that nobody else can do. They won't be able to work you or me or people like us who are already ahead of it, right? So if even if we share our secret, which is an open secret, well, you still have to get to work to get there, right? What what would you tell our audience? You being a passive investor, still making more than a regular passive investor, and how does it work?
Right. Well, I tell people, people that standardly get into real estate, basically using the conception is I'm going to go out and buy rentals. So I'm going to have a single family rental portfolio, which, as you know, you've done it, is very active. There's all kinds of problems. You're kind of a jack of all trades. It's not scaled up so you can delegate it. I mean, you're doing everything kind of yourself, and it's very very active. And so I tell people it's a lot smarter to learn how to passively invest, especially if you're a busy professional or a doctor. And I don't want to go into a doctor and get a surgery and the doctor's thinking about what's going on at the apartment complex. I want them focused on their job.
Yeah.
So if you're going to be active, you really have to be all in. Like, this is what I do full time. So from that perspective, it's not that. I think that I like to invest passively in every deal because I want to give my investors comfort that I'm putting my own money in too. But I believe that, like, the passive investing is what gives you the true time freedom. So you can go, like, let's say you're a doctor, go do what you do best, do your career, and you do what you do best. And then you get with an operator and they do what they do best.
Yeah.
And the people that can really do this, especially in multifamily, this is a very rare breed. And I tell people that are trying to get in the business, because there's a lot of people that are like me. I see myself 3 or 4 years ago, and people come to me all the time. It's like, yeah, I'm just going to go out and buy a 30 unit and I'm going to learn, I'm going to work my way up. And I'm like,
Yeah.
well, It's a lot harder than you think, and you're gonna have a lot of problems and people investing with you. If you're a rookie operator, which I don't recommend investing with these people at all, you're it's extremely, extremely risky to go do that. And like for when you do what I do, like the capital raising, like when I saw my deal, and then I saw the first deal we worked on, the people that are the elite A team people in Houston that run apartment complexes or whatever market you're in, they see every deal first. They see the really, really good deals and they pick those. And then if the broker can't, this is off market at that point, then they go to the B team, then they go to the C team, and then would go to a guy like me 3 years ago or some rookie that like doesn't know what a good deal is. And they try to buy it. Then if they can't do that, it's LoopNet or Crexine. It's out to the general public and they're just throwing a net out trying to get somebody to buy it. But everyone's already looked at it at that point. So I think the advantage of working with really experienced operators, you've got a lot lower risk profile, but also the deals are going to be a lot better because if a bank has a problem with a deal or somebody's just stressed and they got to close in 60 days and it's an emergency, they're going to go with somebody that's a proven closer. And there's just a few people that are going to get that call like, hey, we got an issue. Or can you close this in 60 days? And a person like you can do that. A
Yeah.
person like me can't do that even now. It's not possible.
So what you're saying really is that you invest as a passive with other people with the good operators. Obviously, you have a strategy to find good operators, and in my view, you've been doing it really good. You spend time going out, network with people. You go find operators. You do your own due diligence of all the learning that you have done so far. Obviously, losing money and all of those things in between, and the time that you invested between 2023 and onwards. But then you also provide that service as a part of a due diligence to your friends and family and your network. And then you go out and say, hey, look, I like this deal. I'm investing in this deal. I've done these 10, 20, 30 point checklists on a due diligence on this operator and a D and in a real estate. Would you like to invest with me? Right. And instead of you coming with a smaller check or one check, you comes back with 5, 10, 20 checks. And that's where your operator is actually incentivizing you more in a legal framework as a fund manager. Am I saying it right?
Right. I mean, there's different models, but that's definitely one of the models. And when I'm raising money and done a deal, I always want to put money on a deal. Now, I do so many deals now, eventually I might run out or because I
Yeah.
do a lot of deals, as you know. But right now, I'm putting money in every single deal. I'm along with it. And usually when I find a deal and I start raising money, I'm the first money that goes in. I'll tell people in a webinar, I just put $100,000 in this deal. I'm the first guy. I'm like, when they hit the beaches, I'm like the first guy out of the
Yeah.
amphibious landing craft or whatever, going, trying to lead or whatever. So but the important thing is, like, if you're a passive investor, your primary concern is to not lose money. I just can't emphasize this enough. You talked about it earlier in real estate, if you focus on not losing money, you will do great. You will get great returns. The people that really get in trouble and they hurt their returns are people that are going for home runs.
Of real estate, huh?
If a great operator has a home run and they know it's a home run, a good operator will downplay it. They will be conservative on the underwriting. They will say, we're going to have an emergency. This property was built in 1985. What if a sewer line blows up or whatever happens at the property? What if you have a fire? What something happens? And they'll have contingency. So they'll take a home run deal and they'll downgrade it to a double, where it looks like a double, because it gives them a lot of room if something happens where they're still going to be able to keep their investors' expectations. A rookie will take a deal that is a double, maybe, with a good operator, and they won't operate it. And they'll underwrite it and turn it into a home run because they have an excessive opinion of their own abilities. So as I found, as operators get more experience, they become more pessimistic and more risk averse and more about protecting their track record. And when you have people that are new in the business, they're very confident. They overestimate their own abilities and they haven't had all the problems happen. So they don't really underwrite the way that to compensate for this. And they just think, hey, if I underwrite this deal, okay, and I get a good property manager, we'll be fine. And it just doesn't work like that, as you know.
Exactly. I want to talk about not only the investing part of it or the making money part of it. Obviously, it's important. I always say there's no culture if you don't have money, right? Meaning, and I tell this to my team, we want to do great things about 4 of our team members, meaning employees. Again, there's a different session where I can go over. Our slogan is "It's all about people," meaning we've got succession plan, an improvement plan, a promotion plan, an incentive plan for each of our team members in our team. Each of our team member have a scorecard where that's clearly defined what they're supposed to do. They have a checklist of items, but this is all great. This is what we do. This is our job. This is any professional would do. What impact are we creating? Let's talk about that. I want to give an example, and obviously you can put your perspective. My very first passive investment with somebody in Houston. We toured a property and I asked the leasing agent, where do you live? Again, me being a rookie, very new. She said, well, I live about 40 minutes from here. I was like, oh, you drive 40 minutes back and forth? And she's like, yeah, because that's all I can afford. That hit me so hard that the property that we own, employee sitting in the leasing in the office cannot afford the rents of that property. And that really hit me from a perspective that actually opened me to start exploring more. And I realized that since 1960s, there's an active housing crisis ever since in America. And since 1980s and even after 2000, especially after COVID, it has increased significantly, meaning people cannot afford a good housing in any metropolitan city. So, as Headway, my firm, we focus on boring commercial real estate that are not sexy, that are recession resistant, and that comes under essential service, meaning we issue loans for home renovations. We do multifamily apartment complexes. We are going into medical buildings. All those things are super boring. They're not going to go away as fast as other things would do. People are talking about data aware housing projects and things of nature. I call them it's a syndrome of Bitcoin for real estate. I want to see that's been proven out. But the impact that you and I creating and so many people like us creating in this housing, let's talk about that. I think when you look at apartment and when you investing into value add commercial real estate, what goes through your mind in terms of what impact are you creating when you're becoming a part of those projects?
Well, I think it's an essential need. So this is something that the management side of it or other possible aspects of running the management of these or property management can be affected by AI. But people still need somewhere to live, no matter what happens with AI or where that goes or where that eventually takes us. You have an essential need that AI can't replace. So I like that part of it because as human beings, we need somewhere to live. And even people that are in what we call workforce housing, they want a safe, comfortable, clean place to live. A lot of these people have families, they've got kids. They want a nice environment for them to live in. So we're providing that service. Also, since the prices have gone down maybe 30% since 2022,
Yeah,
and if you look at other things, there's nothing out there that is less expensive now than it was 3 years ago. I
yeah,
think maybe office space, it's a, but that's really hard to figure out the essential need for that at post COVID. Someone told me big screen TVs. I don't watch TV, so I didn't know that. But I mean, nothing's cheaper. Go to the grocery
yeah.
store, go to the gas station. It's all more expensive. So it being priced, value priced, and a lot of the value you get around is the price. It's like that's important is the price per door or the bottom line price on the property. So I see the everything is on sale. This is an essential need. And so that was kind of when I went all in and started like, hey, this is an opportunity of a lifetime. And I had missed the real estate opportunity during the financial crisis. To me, it was a stock market opportunity. The stock market got cut 60%. I was like, let's go in the stock market. If I'd been buying real estate back then, even single family, multifamily, or whatever, I mean, I would be in a lot better position than I was now. So to me, it was kind of the last chance. Like this is an opportunity of a lifetime. And I was in my mid 50s and I was like, I'm going to be Ray Kroc here. I'm going to jump in on this. And if everyone's scared, I mean, I see a huge opportunity. So I started jumping in on that and I took that leap and it's worked out really well.
Awesome. David, I think we are almost coming to the closure. Tell us what you're doing right now. I know you're leading a really good local group called Dealmaker. Tell us a little bit more about that and how, if somebody wants to reach you, how they can reach you.
Yeah, I do a lot of education. So I have a YouTube channel that's my name, David R. Priest. And I try to put my good stuff out there. I don't have any like secret sauce where it's like a mystery, like what I do. I try to put everything out there. I'm a little different, like operators like you. You guys have priority property management. Man, you don't want to share it because it's how you do a better job than other operators. Like with me in capital raising, I just throw all the information out there. So I have a YouTube channel. I do a lot of that. I do a live meetup here in Houston. It's called Dealmaker Houston. It's also have a smaller one that's up here in the Woodlands. It's the Woodlands Real Estate Mastermind. That's a small one that we do that's more local. So a lot of it is getting out in front of people and letting people know that there's other people trying to learn and there's people at all levels, because like 3 years ago, I didn't know anything. And when I met you, I knew just a little bit more, but not very much compared to what I know now. And I'm still learning stuff every day. So it's kind of a journey that you go on. I mean, if you're trying to reach me, probably the best way is LinkedIn because you can book appointments on my calendar right there. And people that are my investors, I'm very easy to find. But if I don't know you're not an investor, you're probably going to leave a message or book a call with me. And that's probably the best way to get a hold of me because I stay pretty busy.
Awesome. David, I want you to summarize. If somebody is listening to you, listening to us, they want to invest as an LP, that's awesome. But if they also want to invest as an LP and do similar stuff what you're doing, let's be real. Let's talk about what will it take for somebody to become or transition from passive to a semi-active investor. Obviously, it requires your own personal investment because if you're not investing with a group or with a project, why would you do it with somebody else, right? So give us some nuggets. What is it that somebody should be doing, right? Transition from a passive investor to an active investor. And what are the activities that you're doing on weekly, daily, or on monthly basis?
Well, I tell people that if you're trying to make that transition, to try to be a small part on a great team. So I don't recommend doing what I did or what other people do. Go out and try to buy a smaller deal and try to learn from the ground up. You're going to advance your career a lot quicker if you figure out what your skills are, what you're interested in, how can I add value, and you try to get on a great team. Because if you get on a great team, basically someone's going to tell you maybe on that team, hey, you got some really good ideas here, but this part of what you're doing is wrong. And you need to correct this before you get out in the market. And if you're doing it yourself, the market's going to tell you when you're doing it wrong, and then it's too late. And especially if you're going to go out and raise money from people, you need to be super humble, super careful. And by getting on a good team, you're going to learn a lot faster. You're going to build your credibility a lot better. Also, with great operators, what's great is if you're raising money on a team, you can let them go out and be superstars. It's like you can be on, like, I'll give you an NFL example. I don't watch football anymore, but I know one player that's in the NFL, and you could be like sitting on the bench and be the worst player on the team, but you still get a Super Bowl ring just like everybody else if you win the Super
Yeah.
Bowl. So let them shine and let them do what they do and approach it with a lot of humility.
Mhm.
And it takes a lot of time. I mean, one of the reasons I decided not to be an operator when I walked, because I could have gone and tried to get another deal and all that. I pretty much figured out it was going to take 10 years to get really good. And I
Mhm.
was like, I'm too old for this. I don't want to do all this stuff. I don't want to have all these problems and go through that journey. So I found out what I did good. So I think it's better to try to add value and admit that you can't do anything and just try to be part of a great team. And if you can be on a great team, that's going to accelerate your journey a lot faster. It's going to be a lot easier for you and you're going to have much better success with that. Cause like with the right people, it'll just pull you up naturally, makes it real easy.
Awesome. Well, David, thanks for your time. I tried to keep it for 30 minutes, but I was thoroughly enjoying what we were talking about. I think we're about 12 minutes over, and that's all good. There's only one question so far. And it's a very interesting question. I want to take it. It hits the mark, it hits the reality. I'll ask, what's your approach as a passive investor about capital calls? So
Okay.
let's define capital call. And you take your answer, and let me answer this first, and then you take the floor. A capital call means that you invested in a project, and for whatever reason, the project is not performing, whether it's low occupancy or some crime um, or interest rate spiked or market turmoil or whatever. And a lot of times, um, back in the last 4 or 5 years, people have paid too much, right? So your project not performing, your business needs money, and that money is a big amount, meaning you and the operator and the investors have to bring some portion of money back into the project to to be able to sustain that negative cash flow. So that's what it's called capital call. In my definition, if the operator is not putting the money first, they should not be asking for a capital call. Now, it's not possible. Is it possible every single time? Maybe, maybe not. But there should be a very clear communication and a very clear understanding of exactly what happened, how operator is trying to help the 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 deal. When we say deal, it's a commercial real estate, meaning it's also a business. And then they have to go out and ask for help from the investors and sustain that to be able to turn around and sell the property. hopefully for the profitability. David, how do you, I'm assuming you have not gone through that cycle, luckily, just yet, but what's your take on that?
Yeah, I've been really lucky because of my timing was really good getting into business. I kind of got into business after the crash. So all my deals were at a buy basis that was very low and I got in at the right time. Now, people that are having capital calls, it's a lot of it's because of timing, and so I always tell people I'm not smarter than anybody else. If I got in the business in 2019, I would have joined a big name mentoring group. I would have bought 7 properties and probably lost 2 of them. So, I mean, I feel like that would have happened to me. I know it's happened to a lot of people. There's a lot of bad things out there. I can tell you how to avoid capital calls. In my opinion, because none of my deals I'm in right now, I've had one. I have one deal I'm passive on. They kind of did a soft cap. I call it a soft capital call. They didn't call it a capital call. They just said they would like people to put in some more money if they can. But I know the operator on that deal that I'm a passive on has the money to do it themselves, and so they shouldn't even have done that. They should just put the money in themselves and just been done with it. Best way to avoid capital calls on these deals is to get an operator with 10 years experience or more that really has a good track record in multifamily, and they are only in multifamily. They're not a jack of all trades doing storage and doing, every single thing. They're really in multifamily, focused on multifamily, or they have a good track record in that. They're getting fixed rate debt. So we might differ on opinions on this on bridge debt, but I'm really, after what I saw, I'm just not a fan of bridge debt at all. I don't know what interest rates are going to be in the future. So get fixed rate debt, get deals at cash flow day one, and they've got good reserves and they have a plan to increase the cash flow, and be careful about promises of big expense cuts on the property. It's really hard to cut expenses. It can happen. You can get better insurance. There can be plans, but generally expenses don't go according to plan. So it's very difficult. So mainly to summarize that, experienced operator, 10 years or more, fixed rate debt for 5 years at least, and then also having deals that cash flow right away. Because if people tell you this deal's not going to cash flow for a couple years, it may cash flow never, and they may run out of money, and that's when you get capital calls and you have a lot of problems.
Yeah, no, absolutely. I want to share um, we can share. I did one webinar last month where we talked about good, bad, and ugly. And there was a speaker, a guest speaker for somebody that I knew, gone through a cycle of, he was almost, he called himself a deal junkie. He bought so much so fast, so quick, couldn't sustain it. But there's certainly cases where operator needs to know exactly what went wrong, right? I had a property, um, had a crime issue, and that property was taking some section housing. We went in and we closed that chapter of section housing, and we quickly realized that that property was so much famous on the section housing that historically it was always be into the rental help housing sections. Um, and now we basically went, so, okay, well, what do we do better to bring those clients again, because we still, the property still need cash flow. So those are learning that you always get hit, but again, if you stay on top of it, things, if you know exactly what the plan is, um, it may be a negative flow, a negative cash flow for a few months, but it's going to go back up. Once again, your operator needs to know what they're doing.
Yeah.
Well, with
And I
that,
think,
Dave, thank you.
yeah.
Go
Oh,
ahead.
go ahead. It's okay.
No, go ahead.
I'm also too on capital calls. It's a very difficult decision to know whether you want to participate in that or not. And that's where the decision comes. Is this something where they're going to bring enough money where this is going to fix the problem? And this is something that's going to make the project successful and it may be worth the stretch as a limited partner? Or is this something where we're just
Yeah.
kicking the can down the road and we're delaying the inevitable? And on a capital call, you've got to make that decision. That's a very difficult decision to make. And you've got to, it's like being in Las Vegas and you're at the table and I don't gamble, but you're behind and you decide to double down. And is that a good move at that point? So I think the best thing about capital calls is try to avoid it at all costs by going with better operators, conservative deals, and not trying to hit home runs. Every pitch deck is going to look good. Every deal is going to look good on paper. When people are promising you home runs, I would be very careful with that. I would
Yeah.
just go for a more conservative deal.
Absolutely. Yeah, and in all clarity, in all honesty, this is a topic that take another hour because there's so much into it. Easiest advice that I can give is talk to your operator, find out exactly what happened, what is the plan going forward, have it in writing. Right. I mean, that's what something I do it whenever I go to my property and if I see something not working. We have something called property priority sheet. So even if my investor walks in, or my partner walks in, or my key principal walks in, All we have to do is we have to open the marketing our property priority sheet and see what has been working, what's not been working. Say something is falling apart, and they're working on it. I want to see if there's a plan behind it, and my investors should see it. Again, it goes back to operations, your operation skill set, how aggressive you are, and that's 50% of the job. 50% is definitely market. But that's a great question, David. I truly appreciate your time, and hope to see you soon. And people who are in Houston, definitely reach out to David. I think he's super active right now. People who are trying to transition themselves from passive investing to active investing or in between, you got to do a lot of marketing. It's a lot of work to be able to raise capital for some other operator, and you have to know your stuff. You have to know what's the ins and out before you can do that. So thanks for sharing that, David. Appreciate it. We will be uploading this recording for you and for our audience, and we'll go from there. Thank you.
Thank you so much for having me. And thank you so much you've done for me, giving me opportunities in the business, getting me started, mentoring me. And it's been a huge part of my success. And you kind of got me started. So that was a really great thing. And I appreciate that. And you do great things for investors. And you're a great place, your whole firm to place money because you really do care about the investor capital.
Appreciate it, David. Thank you.